Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
Tesla, Q4, fundamentals, and valuation are moving out of sync. This article was written by Brett Ashcroft Green. Tesla Inc.'s valuation has decoupled from fundamentals, with EV/EBITDA multiples near software levels, despite contracting core automotive performance. Automotive revenue and margins continue to decline, while smaller segments grow but remain insufficient to offset the core business slowdown. Dilution-driven CapEx expansion risks pressure future returns if robotaxi and robotics investments fail to generate near-term TSLA EBITDA growth. Market optimism rests almost entirely on future subscriptions, particularly FSD and robotaxi adoption, not current earnings or cash flow trends. TSLA stock remains a vision-driven hold, where sentiment and leadership outweigh traditional valuation discipline for investors comfortable with uncertainty. Fundamentals are out the window for this stock. I previously covered Tesla Inc., TSLA, back in July of 2025. I believed it was a hold then, and even more so now, as the stock detaches further from fundamentals. The story then was that CEO Elon Musk was leaving the Doge department on Capitol Hill and returning to his digs in Austin, Texas. The stock at the time was the most expensive stock in the Mag 7 on just about any fundamental calculation. After running up even more since then, that extreme has widened. On a forward EV to EBITDA basis, Tesla is now getting close to touching 100x FWD. Estimates are anywhere from 70 to 100x, depending on the analyst. 91.54x, according to Y-Charts. On the surface, a company like Tesla that largely raises capital through issuing new shares doesn't get dinged if money is raised at more favorable share prices, and cash is not wasted on projects that are not accretive to EBITDA. The multiples expand through dilution if the new capital is spent on CapEx projects that do not have near-term benefits to EBITDA and do not reduce net debt. This seems to be the mode that Tesla is hunkering into. This is one of the two Mag 7 companies that regularly finances through share sales, the other being Amazon, AMZN. We can see the other 5 of the Mag 7 have share buybacks with falling share counts. These counts aren't rapidly falling, but they are going in the right direction for shareholders. My comments on earnings. Post Q4 annual report being released, my comments on the earnings were the following. With another full year of delivery declines, lower GAAP EPS and revenue contraction, we would assume these to be negatives. Smaller segments like energy storage continued to grow at a record 14.2 GWh for FY 2025. FSD and robotaxis are the big story that still keep investors driving this higher, anticipating future, yet-to-be-seen growth. If Musk can keep selling the story, the stock can trend higher regardless of worsening fundamentals. There are few, if any, stocks like it. A pure bet that Tesla will dominate every aspect of physical AI. How the headlines read. Most headlines that I browsed post-earnings release were akin to Tesla beating expectations. Open the articles beyond the headlines, and you see decreasing car sales, decreasing GAAPES, and decreasing revenue on a year-over-year basis. If we're being honest with ourselves, analysts and writers have to have a solid basis for calculating growth rates in revenue and earnings, and then applying a market multiple to that, similar to how one would draw up comparisons to rental real estate in specific zip codes. If rents or cash flows are not expected to rise or might retract, the price an investor would pay for that property would either stay steady or decrease. Analysts are still very optimistic about Tesla's earnings potential. We can see high software as a service SaaS-type growth rates being predicted for EPS through 2029. This expected growth, in my opinion, cannot come from auto sales, energy sales, which are also raw material-intensive lower-margin businesses, or even robot sales, Optimus. I think it will have to be based on subscription models. Most believe that Tesla will begin an intensive CapEx ramp-up for the robotaxi business and possibly further financing of the physical robotics business. This narrative is widely met with positive reception, but the cash generator, the automotive business, is now showing that it has hit a plateau. BYD, BYDDF, has overtaken Tesla as the global EV sales leader. Tesla is the flagship US brand, and several countries, like Canada and the countries of the EU, are signing more deals to import Chinese EVs and opposing US imports. Digging into the report, table content was removed from this audio recording. Please check the text version of the article for details. Although the headline reads as if more segments are growing than shrinking, the growing segments are a fraction of the size of the automotive segment. Table content was removed from this audio recording. Please check the text version of the article for details. With primarily Tesla dealers being able to service Teslas, this has logically funneled a growing revenue number into the system, with more vehicles on the road for the services segment. Energy storage, in my opinion, is the only story worth highlighting, with the potential for data center energy storage from solar and off-peak hour power plant generation. There is potential to grow a lot here, but the margins will be hard to ascertain. Lithium prices COM seem to be heading upward, which could increase the megapack cost of goods sold. Operating margins are now stabilizing at 5.7%, where they were as low as 2.1% in Q1. As we can see, both gross and operating margins have been on a downward trend since 2020. Let's compare these margins to a more subscription-oriented company like Microsoft, MSFT. As we can see, Tesla consistently operates with margins similar to the automotive industry, not the software and subscription industry. The closest hybrid, in my opinion, is Amazon, which runs both subscription/cloud businesses and an asset-heavy retail warehouse business. In all honesty, this is the best-case scenario I see for Tesla, being able to hit double the current gross and operating margins. Will that lead to the type of exponential growth analysts expect? That will all come down to sales volume, Tesla's current plan. The main theme of the earnings report thus seems to focus on the robotaxi ramp-up. This is the most near-term realistic driver of earnings and subscriptions to software to create new revenue. From watching Musk speak about the vision, I interpret it as something like this. Robotaxi market expands. Customers get to subscribe to a special FSD service to put their cabs to work. Entrepreneurs buy fleets to put to work. The entrepreneurs grow both automotive sales and software subscription sales. This trend keeps compounding, and Tesla can also operate its own fleets in the most profitable markets. Risks and summary. As I mentioned, Tesla is unique because you cannot really put a price on it or put a multiple on it. I think analysts who do intricate calculations in the face of falling numbers in the core business are making it up as they go. I personally believe Tesla is still a hold. If the auto business perks up and starts to grow again, or if energy grows exponentially faster than expected, I might change my mind if the price doesn't grow out of control in the meantime. On the flip side, as long as Musk is at the helm, holders can still be rewarded as he sells a vision of the future, and people want to invest in that. I don't blame those investors either, but I'm simply an investor who is very rooted in fundamental logic. This article was written by Brett Ashcroft Green.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.